Welcome to this investing series. I have only one goal for the next few years, having $500 each month in dividends passively from the $500 invested each month. And again, each time I will invest in front of you to show you which stocks I buy, why I buy them, and also how I adapt to the market. And above all, this will allow to invest at the same time as I do. Hi, Jared here, and today let's invest in the stock market. So, for the last month, my $900 portfolio went up and down. I'm truly not interested in Mr.market on the roller coaster in the short term. And my portfolio increased by around 1.6% this month, so roughly $22. And there's good news, despite that fluctuating market. I received dividends from two companies at the beginning of November. First, on November 10, I received a dividend from Apple, so $0.23, but as I own only 1.3 shares of Apple, I received $0.06. And it's not over yet. We're subtracting the tax, which gives us a dividend of $0.05, which does not seem good at all, right? It's almost ridiculous. But this is only the beginning, and let's see what this dividend will be in a year or two. I've also received a dividend from Procter & Gamble of $0.26, subtracting the tax, and this gives us $0.22. So let's continue this challenge with $500. Now I decided to divide it into 5 for the 5 stocks I will buy today. So $100 a stock. And it is now time to invest. This video will be different from the 3 previous ones. I decided to reinvest my income into stocks I already own, simply because I want to own more shares of those good companies, and also because I need to diversify my sector's portfolio. There is only one exception to the rule. I will invest $100 into a new company I didn't own previously. It has a huge competitive advantage and market shares, and Warren Buffett himself invested in it recently. The first company was founded 46 years ago in 1976 in California in a garage. It is the world's biggest company by market cap, the 4th largest personal computer vendor by unit sales, and the 2nd largest mobile phone manufacturer. And the company also became the first publicly traded US company to be valued at over $1 trillion in August 2018, then $2 trillion in August 2020, and most recently, $3 trillion in the beginning of 2022. You get it, I am talking about Apple. The company has been paying dividends continuously for more than 33 years now, and despite the crisis, experts consider its dividends to be safe, which means it will not be cut. Moreover, it has a current dividend yield of 0.66%. And Apple's net income increased by about 19% a year on average for the past 5 years. It has a PE ratio of almost 25, which is pretty average. It is used to determine the value of a company, basically. And on top of that, the tech company unveiled its new iPhone lineup with notchless design along with bigger Apple Watches and iOS 16. Alright, so let's start with the first company. So Apple, as I said, I will create a savings plan, which is basically the same as buying the stocks, but with no fees, which is pretty cool in my opinion. Monthly, yep, in the beginning of the month, €100 or $100. That's basically the same today, at least. Let's continue. And there we go. The second company was founded 44 years ago and is the largest home improvement retailer in the United States. With 500,000 employees, the company primarily serves homeowners, professional renovators, electricians, plumbers, and painters. I am talking about Home Depot. The company has been paying dividends continuously for 43 years now, with a current dividend yield of 2.85%. It increased its net income by a whopping 27% in 2022 alone, with an impressive return on capital of almost 32%. Moreover, Home Depot's earnings per share, so the company's earnings we get for each share we buy, is at about $15. And its PE ratio is very low, at about 16, while the industry is at 46. It is a clean and solid company. So the second company is Home Depot. Home Depot, there we go. Monthly, beginning of the month, €100. Alright, there we go. Alright, the third company was founded in a one-car garage in Palo Alto by Bill Helwet and David Packard in 1949 and initially produced a line of electronic test and measurements equipment. The garage at 367 Addison Avenue is now designated an official California historical landmark and is marked with a plaque calling it the birthplace of Silicon Valley. The company won its first big contract in 1948 to provide test and measurement instruments for Walt Disney's production of the animated film Fantasia, which allowed Helwet and Packard to formally establish the company. And the company grew into a multinational corporation, widely respected for its products. Of course, I am talking about HP. The company has been paying dividends continuously for more than 20 years now, with a current dividend yield of 3.43%. Moreover, its net income increased by almost 40% a year on average for the past 5 years, with an impressive return on capital of almost 70%. Its earnings per share increased by around 20% a year on average to reach 3.79 today. Moreover, it has a good PE ratio of roughly 5, when the average of the US industrial sector is at around 28. So the first company is HP. There we go. As always, beginning of the month, $100. And there we go. The fourth company is in the energy sector, and if you own a car, you've probably been there to spend half of your income last month. It was founded 140 years ago and is still highly relevant today. I am talking about Chevron. The company has been paying dividends continuously for more than 33 years now and has consistently increased them for a current dividend yield of 3.54%. And despite the 2020 pandemic and many lockdowns affecting gas and oil sales and prices, the company still shows strong net income and earnings per shares. You might want to choose ExxonMobil, BP, Shell or even Total Energies, which also have good dividends and still profit from the oil and gas crisis currently. But I found that Chevron performed better than others for the past 5 years and it recovered faster right after the COVID outbreak. Moreover, its net income increased by around 400% a year on average for the past 5 years, with a good increase in earnings per share of roughly 8.13 in 2021. Alright, so let's buy again Chevron for the second time. There we go. Monthly, beginning, 800, and trade savings plan. Alright, the fifth and last company was founded 45 years ago in 1987. It is the world's most valuable semiconductor company, which is also the world's largest dedicated independent semiconductor foundry. And a big chunk of its customers is AMD, Apple, ARM, Broadcom, Intel, Texas Instruments, and Nvidia. Moreover, Warren Buffett recently bought shares in the company, which might indicate that this great company is a buy at that price. And you may have got it, I am talking about TSMC. The company has been paying dividends continuously for almost 20 years now, with a current dividend yield of 2.26%. Its net income increased by more than 13% a year on average for the past 5 years, with a good increase in return on capital of roughly 12.50%. Moreover, it has a good PE ratio of roughly 17, when the average of the US industrial sector is at around 20. And finally, the new company to my portfolio, TSMC. There we go, pretty cool company. Again, 100 as always. There we go, there we have it. 5 companies that have big competitive advantages compared to their competitors and big market shares, and I want to profit from this falling market to buy even more share. And if you have enjoyed this video, then you will like this one where I talk about Apple, which owns the world, or this one where I invest in front of you in November. Thanks so much for watching, feel free to leave a comment down below, subscribe if you want to see more, and as always, I will see you in the next one.